Are you properly managing your investment risk? Today, we cover 8 common assumptions about risk and why they're false so that you can have greater confidence in your investment strategy with fewer surprises. Good morning, good afternoon, good evening, ladies and gentlemen, whenever you might be consuming this valuable information. I'm here today with my good friend and co-host for these Friday editions of the podcast. Got Marshal Johnson here with me.
Hey.
And this is our opportunity to typically, and today, cover one of our weekend reading for retirees email articles. So every single Friday, we send out one email with 4 articles on trending topics in the financial planning space, all designed to keep you on that leading edge so that you can make the best decisions about your life savings, from investment strategy, tax strategy, income strategy, so much more. And not only do you get that email with summaries and breakdowns and takeaways for myself, but you'll also receive special invitations to our webinars, live events even, and white papers, book giveaways, so much more. You can sign up by just shooting us a text at 866-482-9559. Text us WR, that's WR to 866-482-9559, and we will send you a link to get yourself signed up. Today, we are getting nerdy with y'all. We're covering an article from Advisor Perspectives titled, Why Volatility is the Wrong Measure of Investment Risk. Now, I know that may sound a little nerdy, may sound a little bit, I don't know if I want to consume this information.
Yeah.
But here's the thing. If you're going to make an investment, what do you need to understand? You need to understand the risk that you're taking on. If you're going to make a business decision as a business owner, you want to understand the risk that you're taking in that decision. The reality is that most of the time, in business, we never say, well, when we make this decision, we buy this new business, we do an acquisition, or we buy this piece of real estate, we don't measure the volatility of the purchase, right? We're not measuring the volatility. Wow, this is a really volatile purchase that we're making. We think of it a little differently. You might be saying that, but you're really measuring something else. You really want to know, what's my downside risk? What's the worst thing that could possibly happen? What's the frequency that that's going to happen? What's the
sort of return am I going to get on my investment?
What are the odds that this is actually going to come to fruition, where we have this great downside risk that we take on? Now, investing, it's a little different. In investing, you're always talking about this measure of volatility. It is a standard that's been around for a heck of a long time, and there's a lot of issues with measuring your risk with the historical measures that have been used. Volatility as measured by standard deviation.
Ever since, Harry Markowitz, Nobel laureate Harry Markowitz, 1952, kind of pioneered this thinking along with the modern portfolio theory, and basically advisors have kind of adapted it for the last 50, 60 years. Prior to that time, it's pretty amazing that volatility of returns was seldom a consideration when assessing portfolio performance. Prior to, it has its usefulness, but there are vast limitations, and I think advisors and individuals are putting too much stock in, pun intended, in the equity of measuring risk with volatility.
Carl, what hits me here is Carl Pearson first coined the term back in 1893. Standard deviation was coined back in 1893. Harry Markowitz wins a Nobel Prize for it, 1952. It's widely adopted, by it kind of becomes the standard of retirement income planning. The 4% withdrawal rule. We're measuring the odds that you are actually able to take 4%, adjust it for inflation every year over a 30-year time frame, as measured by standard deviation. We're talking about a tool that was created not just decades ago or 70, 100 years or more ago, where now we're still using
dog years? Is it like cat years and dog years? Like technology over the last, that's like the last 700 years.
It's not any different, right? If you want to stay on the edge of technology, if you think about how quickly things are moving in the age that we're living in today, you're upgrading my iPhone's freezing on me again, right? I don't know if they've done that on purpose, but I'm saying I got to get a new one, right? I've got to continually continually stay on the edge of what's going on with my iPhone, what's the latest app, and everything continues to evolve at a faster pace. You need to know what cryptocurrency is, et cetera, right? You need to pay attention to how quickly things are evolving in the technology space. It's not in the medical world, right? It's not that much different in the financial world, but most of the time we see people planning like it's 1985, right? The world has vastly changed. The way that you receive financial advice, the way it's delivered, the way you pay for it, your options when it comes to the different tools that you can use, from financial planning tools to actual investment products. There's so many different things that you can do today that it's important. And I know our listeners know that, right? That's why they're here. That's why you've signed up for weekend reading, so that you can stay on the edge of these things. And what this article is really honing in on is that we need to start thinking about volatility differently. We need to start thinking about risk differently, measuring risk differently, and helping you better understand that risk. And there's different measures that we can use to do that. And the historical measures don't provide the big picture that you're probably looking for.
Yeah, standard deviation really was a somewhat simple calculation that you can use to, look at two stocks, compare stock A and B, or when you build a portfolio, compare the wide range of outcomes, right? And it was easy to go, okay, 95% of the time you're going to have a range of returns of -15 to +17. Are you comfortable with this? And it offers some insight, but it's not the be all.
Well, here's the thing. It's simple, right? It's mathematically simple. It's simple to interpret, but we'll come back to that. It's easily used, but it doesn't address all the major risks you're going to face, especially throughout retirement. It doesn't mean probably exactly what you think it means.
Sure.
We're going to dive into that here in a moment. And it's based on assumptions that don't really fit the real world, right? It's just a mathematical tool that goes, this is kind of what's going on. And think about the definition of investment risk. The chance that an investment strategy will not allow the investor to fulfill their aspirations and meet their obligations in life. It's about accomplishing your goals. It's about getting somewhere into the future, someplace that you're not at today. It's about reaching that goal. Is my risk of not hitting that goal, right? It's talking about downside risk. Risk is a one-sided concept associated with the likelihood of negative outcomes. If I'm going to go do this, how bad could it be, right? But when we look at standard deviation, volatility, which is the standard measure that most advisors are talking about, when you sit down with them, they're talking about volatility, talking about standard deviation. That's a two-sided measure. It's treating both the good outcomes and the bad outcomes equally.
Yeah.
What do I care about as a retiree? I care about the bad outcomes. What are the odds that I'm going to get a negative return, and how bad could that negative return actually be?
Right. I just love the fact that it's been standardized. It's been accepted, and I think that's what we're talking here about technology and the way things are improving. We're trying to find better ways, always seeking a better approach, and this is the conversation that's going to advance some of that for some of our listeners, trying to understand beyond just these standard tools, standard ways to look at risk, and what does it really mean to my plan.
And I think the first point here is one that a lot of investors are experiencing in 2022, right? That is, a portfolio with historically low volatility may have hidden exposures to unexpected tail events caused by structural factors. You might allocate that to a thought around fixed income today, where you had, historically, this 80-20 portfolios had pretty low volatility, right? And then we get 2022.
Lost 20% on government bonds.
Well, heck, you could look at UST, right? You could look at stable coins, right? Yeah. Stable coins, they're really stable historically. We haven't seen them really come off of a fraction of a percent. Yeah, right. However, there were some structural issues being backed by Terra, being backed by Bitcoin that led USDT down a very bad path, right? And so there were some structural issues that really only came to be an issue when there was overcrowding. There was a sharp run for the exit that led to structural issues that led to a decline in something that had historically very low volatility, or structural issues being rising rising interest rates in a very, very low interest rate environment, and correlations this year, right? Correlations increase in times of stress. And what we want to do is we want to add asset classes with maybe high historic volatility that actually reduce the risk because they're negatively correlated to the portfolio. An example of that might be gold, right? You have a highly volatile asset that might be inversely correlated to something else that you're holding inside your portfolio. Maybe it's an inverse ETF for that matter, but you want to create some negative correlation with some of the assets that you're actually truly creating diversity inside of that portfolio. And thirdly, volatility isn't measuring the risk that you have with concentrated positions in your portfolio. And Marshall, you and I were talking about this previously. We see new advisors that might struggle with this. New advisor comes in, client brings in a portfolio, and they upload it, take a look at the risk measures, take a look at Morningstar, take a look at Riskalyze. They use all these tools, and they find, boy, this portfolio of 10 stocks or 5 stocks has a pretty good standard deviation and really good returns. If we were to reallocate that to a different model portfolio, well, we're not really providing better expected returns or lower volatility. We kind of end up with something that's not that much better, seemingly, but that's because it's not taking into consideration the risk of that concentrated stock position, right? And I'm just giving this as an example. I don't know the volatility or standard deviation of GE, but let's say, well, GE has the same volatility as the S&P 500. That doesn't mean it has the same level of risk as the S&P 500, right? Because GE could go to zero conceivably. Albeit probably against all odds, but what they say about Bear Stearns and what they say about, these things happen, Kodak, right? These things happen, and we need to take into consideration not just the volatility of the portfolio, but a lot more than that.
And you brought this up earlier when we were kind of talking about the article. Think about muni bonds. Muni bonds are going to have a low standard deviation. They're going to be seemingly very safe because very, very few events have occurred where municipalities have actually filed for bankruptcy. But it doesn't mean it can't happen. Right? We could see entire states maybe file for bankruptcy someday. So you just have to understand how the correlation between the standard deviation, the risk measurements, but also the overall portfolio and how these things all come together to challenge our assumptions. Right?
Well, and they offer a really good example, a good sequence chart saying, hey, we've got 10,000 different numbers. We have 10,000 numbers. And if we had a random sample from a normal distribution, an average of 0, standard deviation 1, so it's positive 1 or negative 1, usually somewhere in between. That'd be a normal distribution. That's kind of the way it goes like this, right? And then you have alternating values. So it's negative 1, it's positive 1, it's negative 1, it's positive 1. And then you have, well, their constant small and positive values are 0.01, 0.01, 0.01, negative 100, right?
Big
in
drop.
Sequence number 10,000. If you looked at the standard deviation of all those, or the volatility of all of those, the volatility measure, if measured by standard deviation, the kind of the principal tool that advisors are using, all the standard deviations would be the same.
All of them.
I don't think a retiree would look at that and go, okay, that is something I'm comfortable with, where it's pretty level, and then all of a sudden I can lose everything.
Huge drop.
Right? So that is where we're getting, is it's not a good measure of risk when it comes to your portfolio. There's just some common assumptions that are made around risk that in volatility and returns, that we need to get on the right track in order to make better investment decisions, have more confidence, which comes from having fewer surprises.
Yeah. So you talked about these assumptions. They list 8 of them in here. Let's cover them really quickly. Returns are independent of the past. Well, that's an assumption that a lot of people believe, but the reality is returns often exhibit dependence on recent past in the form of trends and auto correction, which is the tendency to move in the same direction, or mean reversion. This is a big one right now. Think about all the meme stocks and all the darlings of the 2020 COVID. Think of Peloton. I mean, that's the best example. Stock was up, 600% from its March 2020 lows to its recent highs, and now it's fallen 91% since those recent highs. Mean reversion.
Yeah, things tend to revert back to the mean. So yes, the returns aren't entirely independent of the past, and the past is a pretty good predictor of what we're going to see in the future. Number two, volatility is constant in all periods of time. But this is kind of what standard deviation teaches us, right? If we look at it, we're usually looking at it over a very long period of time. You're probably looking at it using 10,000 different scenarios in a Monte Carlo simulation. You're looking at it over the last 100 years of stock market returns, and you go, well, within a 95% confidence interval, this is where you should land. However, what if you ended up retiring in 1999? What if you ended up retiring in 1999, when ended up your first 10, 12 years in retirement, you had massive volatility and net zero returns in the S&P 500? What if you retired in the financial crisis, right? You could retire in a heavy tail. A very dangerous heavy tail is where you could end up retiring. And retirement doesn't, you're not going to get to retire today and retire for 100 years, right? You don't get to use 100 years of returns when you retire. You get to use those returns you're going to get right now. And you could be retiring in a tail risk. And if we talk about 95% confidence interval, that means 5 out of 100 times it's not going to land where you think that it's actually going to land, or where you've maybe been sold that it's going to land.
Yeah, it's like that article where we reviewed the other day. You know, you can cherry pick data. I saw a post on Twitter. The guy was going, well, look, this has never happened in history. And he showed a chart of the VIX. It's like, well, it only goes back to 2004. This is not the entire realm of history. This is just the most recent 18, 20, 16 years, whatever.
And then you have correlations between securities being constant. That reminds me of the permanent portfolio. Right?
Yeah.
Permanent portfolio, guys, not doing real well right now.
The all-weather portfolio. Right?
The all-weather portfolio was one that, yes, it worked back 30 years ago, right? It's just some of those correlations have shifted over time. Gold has shifted quite dramatically over time. And they always thought Bitcoin was an uncorrelated asset. Now, highly correlated asset to the broader stock market indexes, right? So these correlations between different securities, they're going to evolve over time, and they tend to increase. Those correlations increase during serious market volatility.
Yeah, like when you have big time events like March of 2020. I love number 5 here. It says returns are negatively impacted by volatility. No, the reality is volatility is a necessary element to generate these superior returns, right? It's going to shake out all the impatient people. What Warren Buffett used to say, the stock market is a great tool for transferring wealth from the impatient to the patient. You need that volatility for those outsized returns.
Yeah, and what Kendrick Lamar say?
Scared money don't make money.
Yeah, scared money don't make money, right? We need to take on risk in order to get bigger returns. I think that's pretty clear. Log returns, number 4, to back up one, normally distributed. Returns have skewness, right? There can be big, large down moves, especially over a short period of time. You can have some fat tails.
It's not a normal distribution, right? It's not a perfect bell curve.
Things are not always perfect when it comes to volatility. It could be slanted one way or another. Number 6, volatility isn't materially affected by any individual point. Well, individual points can have a disproportionate impact on volatility. I think we saw that with that example of, 0.01, negative 100, right? If we go through that period of time, we can say, oh, it had very little volatility, right? And then we experience one individual point that brought it back to a normal standard deviation that is in line with those other examples that we gave just a moment ago. You can have one outlier that creates a disproportionate impact on volatility, and the measure that you're using being standard deviation. Number 7, volatility treats ups and down moves the same. I think this is maybe the biggest takeaway that you should have.
Yeah, upside and downside volatilities can diverge.
Yeah, and again, what do you want to measure, right? I want to measure my volatility to the upside and my volatility to the downside, and not treat those two things equally the same. Number 8, volatility is independent of sampling frequency. The reality is volatility measurements, they vary for different time horizons.
Yes.
But when you plan, again, you're planning for this historical volatility that may have lasted for 100 years. However, that may not be your retirement time frame, may be nothing like that. And the odds are probably relatively low that you hit that, because you are retiring on one day. You're not retiring on 1,000 days.
Hence the sequence of returns risk, right? The most critical period of time is those first 10 years of retirement. Who cares about historical valuations from 100 years ago? It's like, look at today's environment, look at today's numbers, and try to make the best decisions for this environment.
Yeah, and so there are a few alternative risk metrics that are outlined in the article that are better aligned with the client's investment objectives. These can be used to evaluate your portfolio through different lenses, come up with a more reliable, comprehensive view of some of the different inherent risks. And I think these, again, we're talking about investment strategy risk here. We'll get to the broader picture in just a moment. But number one, you have tail risk, right? The chance that a seemingly low risk product could experience unexpected large losses. I mean, what happened to 20-year treasuries?
Yeah, exactly. So if we look at historical data, what we're seeing today in 20-year treasuries is outrageous to the downside compared to what it's historically done.
Yeah.
So you're trying to understand those tail risks.
Yeah, we need to understand that something that has a historical low risk doesn't mean that it's always going to be low risk, that it could change, or it could continue to maintain low risk and have one point of extreme volatility, and then what do? It reverts back to the mean. But it's important to understand that those tail risks can exist even with some of those low risk assets that you might have. You might say, well, that's a municipal bond. I owned a hospital bond down in Texas years ago. I started trading bonds. Our son was sick. I got bored, and I bought a high quality municipal bond in a hospital.
Wait, you were bored. You had time on your hands. You were bored. Sounds like everybody during COVID, right?
Well, and I was semi-retired at the time, so I wasn't working at the time. So I was kind of like a retiree, right? So I'm calling Marshal constantly going, hey, what if we do this? What if we do that? I'm talking about the market. I'm building portfolios. I'm building bonds, right? And I'm doing things that are completely unnecessary that bond, long story short, went to zero, right? You would have never seen that coming. That particular, if you would have a portfolio of those bonds, they had relatively low risk historically.
And I remember us going, well, how often do hospitals file for bankruptcy? I mean, it's not often.
Yeah, but a low risk product could experience unexpectedly large losses. That needs to be defined for you. Number two, a lack of diversification risk. Now, that can be mitigated by introducing assets that have a lower correlation to the investments that you have in your portfolio. Right? So you need to diversify those investments, but you don't just need to. A client said this to me the other day. He said, people think they're diversified because they have 5 different mutual funds.
That's good. That's good. Well, three of them are probably large cap funds because large caps have done so well, especially large cap growth. We saw it at the beginning of the year. Everybody kind of raising the red flag going, hey, look, large cap growth stocks are really overvalued, like 3-4 times the mean here, 3 standard deviations above their mean. Hey, that just, it's a point where you look at it and go, yeah, I wouldn't be surprised if it came back down. Well, look what happened here to start the year. So just being aware of diversification and not chasing returns. We see this from Actually, this article was geared towards advisors, right? This wasn't written for John Q. Public in mind when they wrote it. So understanding how your advisor sees the world, how his firm sees the world, trying to understand that you may lack diversification.
It's a new way of looking at risk. It's just the current trends and the way that we should be planning, especially for retirees. During those accumulation years, you're not so concerned with a lot of these things, right? You get a bad month, you get one of those outliers like March of 2020 and you're 30 years old, you go, who cares, right? But now that you're retired, you actually need those dollars. You can't afford those big extremes that you may incur if you don't have a full understanding of risk. And the risk has shifted. It's not just risk to the portfolio, to the downside, to the upside. We're really talking about reaching that end goal, which is not running out of money in retirement. So there's another element here, which is shortfall risk. That isn't just experiencing losses, but what if you reallocate those assets to something that has low historical volatility? If it has lower historical volatility, it also probably has lower historical returns. You may not achieve a big enough return in order to actually retire when you want to retire. And I worked with a gentleman a few years ago that he was someone that wanted to spend, I think it was 7-8% of that portfolio every year.
Like a higher percentage.
And he didn't want to take on any risk. Well, the unfortunate reality is he was going to have severe shortfall risk if we didn't take on some risk, right? There was no possible way that money was going to last the rest of his life unless he died early. If he was going to draw 7-8% out of a low yielding portfolio, we had to take on some risk. We had to measure the risk of shortfall at the same time.
Yeah, but trying to understand too that you may be beyond shortfall risk. I mean, there are some people that are stressing out about the stock market that don't need more than 1 or 2 or 3% rates of return, but they're still scared that they have to take the risk, so they're driving themselves insane when it's something they don't need, but they don't realize that they don't need it.
Yeah. Well, and that last one, number 4, we talked about concentrated stock risk, so we won't go any deeper into that. We'll leave you with this. Volatility is what? Volatility is at best an inaccurate measure of the risks that you're taking, right? At worst, it's a misleading guide to the most practical way for you to be investing for your retirement. An accurate depiction of risk for you is going to require at least 3 dimensions, maybe 4 different dimensions of a model in order to cover all the aspects of dangers that might be lurking in your retirement portfolio. Now, as we're looking at this today, we're talking about investment risk, and that's one element, but that's just one element. Understanding the risks that you're taking in your investment portfolio. However, there's also those outlying risks as well. The accumulation specialist, the growth specialist might just be focusing on some of these aspects, the shortfall risk, concentrated stock risk, volatility risk, using some of these more fancy measures of volatility in order to give you a better understanding of that volatility in the portfolio. But then there's the outliers, right? There's the long-term care risk. There is longevity risk. What if you live to age 120? What if you have a major health care issue in the future? What about what you want to leave behind to your heirs? You might have legacy risk built into there. What about tax risk? Taxes go up in the future. We need to be taking probably not just a 3D or 4D look at this. We need to be taking a big picture look at this and identifying each one of those major risks you're going to face from investment risk and beyond, and dialing in a strategy that delivers you peace of mind because you can see that big picture. You know where you're at today. You know you're on the right track, and now you can spend with confidence.